this video, I'm going to stick more to the basics of moving averages. I'm going to explain how they're calculated and exactly what a moving average is. In the future, I will be making a playlist going over how I personally use moving averages in my trading style, whether it's intraday scalping on SPY or if it's looking at longer term setups that I'm trying to swing or go long. Now, first, what is a moving average? A moving average is a mean of price over a specified time or number of bars. Now, what do I mean by number of bars? Well, the moving average is based on the time frame of chart that you're looking at. So if you're looking at the daily chart and we're talking about, say, a 200 day moving average, well, if it's 200, it's referring to 200 bars of that chart's time frame. So if it's a daily chart, 200 moving average is referring to the average price of the last 200 bars. If it's a 50 moving average, then it's referring to the average price of the last 50 bars, or otherwise 50 days. Now, if we're talking about the hourly or the 5-minute chart, same goes for that. If it's a 9 or a 50, it's referring to the last 50 bars. Now, another thing to note about a moving average is that it is a lagging indicator, meaning that the results from the indicator are derived from previous information and prices. Now, there are two different kinds of moving averages. We have a simple moving average and there are exponential moving averages. Now, the key takeaway from these, the difference is that the simple moving average is strictly equally weighted average. So if we're talking about the 200 moving average, each bar over the past 200 bars are given equal weight to the average, versus the exponential moving average, it kind of reacts quicker than a simple moving average might, and this is because it gives a higher weight to more recent data. So if it's a 200 exponential moving average, it's going to give more weight to maybe like the last 10 or 50 bars. I'm not sure the exact numbers on that, how it weights it, but essentially the exponential moving average will be moving up and down a little bit quicker than the simple moving average. I normally prefer using the EMAs for kind of shorter time frames. The 9 EMA is one of my personal favorites for intraday scalping, but if we're talking about more longer term setups, simple moving average kind of gives you a more true, meaningful value and kind of helps negate any noise. Alright, here's a chart of NVIDIA on the daily, and on this chart I have moving averages, but these are simple moving averages, not exponential, otherwise known as SMA. A lot of people abbreviate it, but that's what they're referring to. The white line in my case is the 9 moving average, purple is the 50 moving average, blue is 100, and red is 200. You can change these colors if you'd like. This is just what I use, what I'm used to. Even the numbers, and I'll show you exactly what I mean. So this is the moving average indicator settings, and the length is basically what number. So if I wanted to change this to 50, that would change it to a 50 moving average, but I'm not going to do that. Now, everyone uses these moving averages differently. Some like to maybe go long on a break above the 50 moving average. Other people like to go short on a break underneath the 50 moving average. Everyone kind of has their own significance to these different moving averages. For example, me, I like to use the 9 moving average to show more short-term momentum. So you can see on this run right here, price never even closed underneath this 9 moving average, and it ran very strong, and when it finally broke underneath the 9 moving average, you can see we shortly after started to see a lot of weakness, and it came back to test this 50 moving average, caught support, bounced up, came to test the 50 moving average again, and you can see essentially a lot of these pops are a bounce off of one of the moving averages. You can see we haven't tested this 200 moving average for quite some time now. We're currently at the 100 moving average right now, so I would look to see whether this stock is going to bounce off and basically show that there is still some bullish momentum here that maybe it's just been exhausted. But if price were to break underneath this 100 moving average, that would definitely show a lot more bearish possibility to come after that, as it hasn't broken this 100 moving average in quite some time from now. You can see if we do break this 100 moving average, that we might actually see a test to the 200 moving average. And if it were to break that, you could possibly use this 200 moving average as more of a long-term support or target if you're trying to go short, or maybe if you don't like to play the short side, you could wait to see if we get a bounce off of this 200 moving average. There's really so many ways you could play using these moving averages, but one of the main things to consider is that you don't always want to base your trading strategy solely off of moving averages. You want to use other indicators that can help you kind of give a little bit more confidence and conviction in your trades. You want to pair it with other indicators such as like the RSI, or there's stochastic, Bollinger Bands. There's really a bunch of indicators out there. Everyone has their own strategies. Everyone uses their own indicators, but the moving averages is probably the most commonly used indicator that anyone uses. So that's definitely something to keep in mind in terms of psychology. One of the reasons why a lot of these indicators do work is not only because of the math behind it, but if you have, say, 1,000 traders or even 100 traders all looking at the same thing, and say if they notice that price starts bouncing off this 100 moving average, well, that might be showing some strength. So all those traders looking at that bounce off the 100 moving average, they're all seeing the same thing. They might all think the same thing. Now I want to start going ahead and getting into the exponential moving averages. On the left chart, you can see these are all the same values: the 9, 50 for the purple, 100 for the blue, and the 200 for the red. These are the exponential moving averages. And on the right, we have the same chart, same time frame, SPY, and these are the simple moving averages. Now you can see they're essentially reacting quicker on the left. Like I said, the exponential moving averages give higher weight to more recent data. So if we're going to be looking at this red line, the 200 EMA versus the 200 SMA, you can see price stayed relatively straight right here, but we had more of a curve on the 200 than we did on the simple moving average. And it's not the biggest difference. You can still essentially use SMA over the EMA and vice versa, but in terms of longer term, we can go ahead and look at the daily to kind of give you more of a reference. Change this, and let's look at a different chart as well. Nvidia right here, look at the same chart, same time, and look at this 50 moving average for instance. You can see on the EMA it's starting to curl down a lot more than on the SMA, and it just changes a lot quicker with the newer data that comes in with it. So I really like using the 9 EMA for intraday scalping. Let's look at, say, the 5-minute chart on here, show you kind of what I mean. So on the 5-minute, you can see that this EMA is changing quicker than the SMAs are, and you can use that to kind of show you more of a short-term intraday movement and momentum and stuff like that. But those are essentially the differences between the SMA and the EMA. They're very small differences. I used to use the EMAs for essentially everything, and I only more recently started using the EMA only for intraday movement, and I do now use the SMA, but that's just personal preference. And that's the basics of moving averages, exactly how they work, how they're calculated. In future videos, I'm going to go ahead and make a playlist for moving averages, showing how I use strategies to, whether it's intraday scalping or longer term strategies. So go ahead and stay tuned. If you enjoyed this video, go ahead and give it a thumbs up and subscribe, and stay tuned for more content.